Hi, I'm Randy Crane, production accountant for GemStar Productions, and this is an overall financial report for the period ending October 31st, 2024. This first slide is the company balance sheet, and this gives you a snapshot of where we are as a company at the time this report was done. And on the balance sheet, there are three different categories: assets, liabilities, and equity. Assets are what the company owns. Liabilities are what the company owes, and equity is such as stock, retained earnings, profit left over after paying all costs, and taxes and dividends and so forth. In the asset column, we have four different entries: cash, supplies inventory, vehicles, and deposit at vendor. As you see, cash, it's what we have usable to pay our expenses and grow the business. Supplies inventory consists of supplies purchased to create our products to sell to customers. Vehicles consist of company vehicles used to operate our business, and then deposit at vendor is money given to another business or company, but we have yet to receive the services for that. Finally, total is $65,066. Liabilities, we only have one category, which is loan payable, and we took out a $40,000 loan from the bank, and the interest is $233, which is 1 month of interest paid on that loan, so a total of $40,233. Under equity, we have common stock and retained earnings, and the total here is $24,833. The total, one key point about the balance sheet is that the assets and the liabilities must match. So as we can see here that the assets is $65,066, and liabilities and equities total $65,066. In evaluating company financials, there's three different categories that are important for us to be aware of and know about, and that is return on assets, return on equity, and debt to assets. And these financial statements are evaluate companies to see how they're doing in the marketplace. Return on assets measures how we're using our assets to determine our success. And so the calculation is taking net income divided by total assets, giving us a number, which is just an example number here, 0.678, and then we convert that to a percentage, which is easier to read. The net income is found on the profit and loss statement, and the assets are found on the balance sheet that we just went over. So net income divided by total assets. Return on equity measures the overall company so that stockholders and such can see our value. And again, the calculation is net income divided by total equity, which gives you a number, and then that's converted to a percentage. Net income, again, is found on the profit and loss statement, which we'll look at, and then the assets on the balance sheet that we just went over. Debt to assets measures our overall debt leverage, and the debts and assets are found on the balance sheet that we just went over. The measurement or calculation is total liabilities divided by total assets. So these ratios determine our value on assets and equities owned by GemStar, and the higher the number, the better. It also compares GemStar to other companies and their financials. So return on assets, again, we divide net income by total assets, and in this case, we come out with GemStar Productions at 7%. Excuse me, taking the total assets, $4,833 divided by $65,066, which again was on the balance sheet. Return on equity, the same calculation, net income divided by total equity. GemStar Productions, again, is at 19% overall, and debt to assets, the total liabilities divided by total assets. We looked at, again, at the balance sheet, and GemStar Productions is at 62%, which all these ratios point to a healthy and growing company. Next, we have the profit and loss statement, and this is kind of a running total of daily income and expenses over a 30-day period of time. And as stated previously, this is like a running movie of our financial analysis instead of just a picture like the balance sheet is. But under this, we have actual numbers, which is our actual numbers for the month. Budget is what we set aside or budgeted and predetermined, and then the variance is the difference between those two. So as we look at event revenue, this is where we got paid for events that took place, $11,400, less our expenses. And let's look at these briefly. We have utilities, payroll, depreciation, interest expense, office supplies, insurance, and equipment. And briefly, utilities is what we pay for electricity and water, etc. Payroll is what we pay our employees and staff. Depreciation is the amount deducted for the use of the company truck. Interest is the amount spent on the loan that we took out from the bank. Office supplies is what we use in producing our products. Insurance is what we pay State Farm for liability insurance. And finally, equipment rental is what we pay for the cost of renting equipment from Easy Rentals. We have a total of $6,567 of expenses, and we divide that from subtract that from our event rental. We get $4,833. Our next slide is total cash, or statement of cash flow, and this measures the cash coming into the business and flowing out of the business, and it takes the profit on the profit and loss statement and provides three activities: operational activities, investing activities, and financing activities. It adds and subtracts transactions that either add or take away cash, and then provides a total of ending cash, which can be found on the balance sheet. And again, it ties the profit, loss, and the balance sheet together. And as we start, we have net income from the profit and loss statement of $4,833. But these are transactions that did not show up in the net income. So we have supplies inventory, deposit at venue, and interest payable. Under supplies inventory, we actually purchased supplies at $2,000 and only used $667, which left $1,333, which we show a debit from this account because this is an increase. And then we subtract that number, $1,333, because it's a reduction in cash left or available. The investing activities show cash coming into the business from selling fixed assets and cash going out of the business as a result of purchasing fixed assets. And financing activities shows money coming into the company but is not part of the net income figure. Our next thing is to talk about our internal controls, which help evaluate financial accounting. They're important to prevent fraud, help companies stay more financially sound and responsible. And Investopedia has a good definition. It says internal controls are the mechanisms, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information, promote accountability, and prevent fraud. Besides complying with laws and regulations and preventing employees from stealing assets or committing fraud, internal controls can help improve operational efficiency by improving the accuracy and timeliness of financial reporting. There are internal controls, corrective controls, access controls, and detective controls. And in the next slide, I'm going to go over them just briefly. Oh, and I forgot preventive controls. Internal controls can help in GemStar. How can internal controls help GemStar Productions? Internal controls are where we provide procedures to detect fraud. These procedures can help make GemStar more efficient. They are required for publicly traded companies, and it just helps assure financial information can be relied on. Preventive controls, there's three different categories here. Separation of duties, and it just means having different people handling different financial transactions to prevent errors and problems. And for example, our accountant who is writing checks for the company, we wouldn't have him making deposits at the bank or reconciling the bank statements. It just makes things more challenging, but having them do specific duties. Pre-approval of transactions. Our company should not allow everyone to go out and just buy things, but have pre-approval on things, especially big ticket items. Physical control over those fixed assets, like big ticket items, such as computers and things, and we need to have certain people over those fixed assets for control. Detective control. These are monthly reconciliations. So, for example, the bank sends a monthly reconciliation, but the bank statement may not match. And it's because our company may have transactions that have taken place since that statement came out. So having monthly reconciliations is important to just keep up with things. Budget variance is the reason we have a budget, is to make sure we have a plan for the year, and it compares our actual results to our budget that we to see where we are. Physical inventory controls. This is just to detect that all of our products are accounted for. Corrective controls, physical audits. For example, having physical inventory, we do that to make sure that we have all of our product, and then when we know that we do, we adjust our records to account for anything that's missing or have extras. Ledger verification. This is just where we look at each account and make sure that everything is there in detail. Access controls. This is our final control. Badges are used for each staff member and just allows them to be in the specific areas that they need to, so that it protects our information and documents. Logins, only specific people should have access to certain information, such as our accounting information. So we have logins for that, and passwords. Again, only certain people should be given passwords to prevent unauthorized access, to make sure that they have access to the correct information. Some terms and concepts learned. I learned about the balance sheet, how assets, liabilities, and equity are on that document, and the profit and loss statement. I learned how that shows all the expenses, and having a rolling movie to kind of have that as a picture was really helpful. Knowing that the balance sheet was just a picture and the profit and loss statement was kind of a rolling total of how sales and expenses went. Statement of cash flow. This was probably the most difficult for me to understand, but shows the cash flow to determine if the company can pay its bills. And but that was a bit challenging. The accrual accounting, a way to record financial transactions as they take place, as to oppose when cash is received or paid out. That was also a new one for me. Internal controls, having procedures in place to prevent fraud and make a company more efficient and profitable. That was also something I learned. Budgets I kind of knew about, but the ratio analysis, I really enjoyed learning about that, and learning how mathematical equations help calculate the financial standings. So Overall, I learned quite a bit from these terms and what I did with this assignment. And here are the references that I took these controls from for the information. So hope you enjoyed this. Thank you.